Warning: this video and all other videos on this channel are for entertainment purposes only. The content of this video and all other videos on this channel are the opinions of the creator only and do not constitute legal, trading, investment, or financial advice of any kind. Investing carries a high level of risk and the majority of retail clients lose money. Do not invest any capital unless you understand the risks and you are prepared to lose it all.
Alright, hello and welcome to Camel Finance. I'm your boy Camel and welcome to the weekend's deep dive. It's been a couple of weeks since we've done one of these, but usually on the weekend we come back and re-examine the base case hypothesis of the channel and check to see if, largely speaking, things are still going according to plan. So we're going to do that again today. As a kind of preface to this, keep in mind the US government is still shut down and therefore some of the data is not coming out. I'm going to spitball a little bit about why I suggest that might be the case based on some of this data, but we'll just check in on this thing, run through it from the top down as we always do, and we'll see what we can see. So if you're interested in following along, do hit that subscribe button, turn the notifications on, and you can check how this thing is playing out week in, week out, along with the rest of the Camel Crew. Kicking things off with the stock market, the expectation at the lows was we were too bearish, have a blow off top to all-time highs, come tumbling down in a global bear market and recession, and here's the key part: we would have deflation set in the middle of this bear market for about the third time in the history of the US. We've also been suggesting that once this high is in, it will likely remain the high for some length of time, a considerable length of time known as a lost decade. And you can see technically we are setting up to have this kind of blow off top followed by a lost decade in here, whilst the oscillator down the bottom resets itself, just like we saw in all prior instances. Fast forward to today, and I think we are well on our way to the final high. I think this is absolutely undeniably now a blow off top. We are still continuing to be long biased and we can still continue to trade this thing in front of everyone on the way up. But I am absolutely making the case that our days are numbered here, okay? I think that we are well on our way to the final all-time high and we are soon going to be tumbling down in a global recession and a bear market. This whole tariff spill that we had into Q1 of this year, I very much make the case was just this bear trap in this schematic right here, and now we are well on our way to that final high, okay? We're clearly above the prior high from here. I would suggest we're about here, somewhere between renewed optimism and FOMO just about to start. So of course, here's that prior high, the bear trap. We're clearly above that prior high. And again, I think we are just days away now from seeing FOMO kick in and driving this final kind of melt up, blow off top moment. And then I think it's going to be time to top before Christmas has been the idea. If it spills into Q1, it's not my job, right? It's not my job to try to pick the date. My job is to stay long until the trend breaks, right? My job is to take money from the market. So if it spills into Q1, it spills into Q1. I'm not going to argue with it, okay? But it is still my expectation that we're probably going to top before Christmas, or in the worst case scenario, very early January. I don't see us running into February, March, April, May. I don't really see that. I'm here for it, right? If it's going to do it, then fine, I'll stay long and I'll keep trying to add at every opportunity I can. But I really do think that just based on the steepness of this trend angle, especially if we continue to bounce higher like I think we're about to, then I don't think we're getting out of this year without seeing the top. But as always, I reserve the right to change my opinion and stay long for a while longer if the market tells me I need to. But wholly speaking, you can see at the lows, I was suggesting we were too bearish and we'd have a blow off top, and now it seems like we are here, right? Keep in mind there's also a 4-year cycle low for the S&P 500 late 2026. So sure, we can spill into next year, we can make this cycle even more right translated, but on a balance of probabilities, we tend to spend about 3/4 of the 4-year cycle moving up, which we have now done, especially if we top this year, and the final quarter declining to reset that 4-year cycle. So I do suggest we're on borrowed time here, but that's not necessarily a doom post or fear mongering, because like I said, I'm still long and I'm still strong, and I expect to be that way for at least a little while longer. Bitcoin has very consistently been throwing these weekly cycle lows and double. That wasn't until this most recent weekly cycle low. You can see each one of these weekly cycle lows is equidistant, and off those lows we typically get, approximately speaking, a double. It wasn't until this cycle right here, this weekly cycle, where for the first time we fell short of the double, okay? We actually ended up at around 70% off the lows. And so here's an unadjusted version of that chart, and you can see we did indeed fall short of the double. But if I leave everything to the left-hand side of my cursor here unchanged and squish everything else down, then what we get is this. And as you can see right here, at least from a timing perspective, it's not really too far out of the ordinary, okay? It seems like more or less it's still doing roughly what we expected it to do, just we did lose power here. And losing power here to the upside, okay, not completing a double, completing 70% instead of the prior doubles that we saw, is indicative of waning momentum. Okay, that's absolutely true. We must acknowledge that. It's also true that you can see just from this schematic how late we are in the 4-year cycle. And there's a lot of people out there that don't believe in 4-year cycles or want to abandon the idea or want to measure them incorrectly. But on this channel, what we do is we chain together daily cycles to give us weekly cycles like these blue ones. We then chain together a bunch of these weekly cycles to give us a 4-year cycle. And we're not going to cease to do that because that is our edge, right? That edge is proven over time. Many of the Camel Crew, you know exactly what I'm talking about. And so I make the case that there is just 2 more weekly cycles to go. Hopefully we get a left translated push, weekly cycle low, left translation and failure, and that gives us our 4-year cycle low. Okay, so I'm not going to abandon ship on this idea. I can't just say cycles are no longer going to present. And of course, that objectively means we are very late here. We are only 2 weekly cycle lows away from a 4-year cycle low. Now, the cycle can extend. Okay, it can, as I was saying with the stock market, this could spill into Q1. It could even spill into Q2, and that would not break the cycle. A lot of people would be quick to say, well, that's a 5-year cycle, or the cycles are broken, or the cycles are dead. That's not really how it works. It would simply mean that this cycle right translated for a little bit more than would be typical, but it would still ultimately resolve to a 4-year cycle low and a couple more weekly cycles in the middle. So similarly with the stock market, I am expecting Bitcoin to top before Christmas of this year. I expect all these markets to top before the end of this year. And I fully expect to be in mostly cash, if not entirely cash, by the time Christmas comes around. I've been saying consistently, that's really what I would like to happen. I'd like to be able to sell all my positions, go and enjoy the Christmas break, and then come back to what I kind of jokingly refer to as financial Armageddon in January. But again, I reserve the right to stay long and strong for a little while longer if the market proves to me it wants to run into January or February or even March of next year. Now, in theory, if we are going to get a bounce to new high and we haven't seen the top already, then we should expect a big left translated weekly cycle here. Okay, that would make sense to end the bull phase of the 4-year cycle. But we also have to be honest that number one, we were exhibiting waning momentum into this last weekly cycle high. And since then, we have used up a great deal of the bull phase here. So time to take note here, time to make sure that we do indeed get a big strong push here into a left translated weekly cycle high. Otherwise, if we continue to kind of chop and range sideways, it would speak to the top already being in and then us doing something like this to give us that 4-year cycle low reset broken up by a weekly cycle low in the middle. So I can afford to push the trade a little while longer here just to see if we can get that big rip into the end of the year, that big kind of blow off top moment into Christmas. A lot of people seem to have given up on this. To be honest, my confidence is at all-time lows for seeing this next kind of blow off top move. But maybe that's an indicator, right? If even my sentiment has been reset, then maybe that's an indicator that we are about to go and melt faces here. I will say this though, as somebody that trusts and believes in these cycles way more than almost everyone, frankly, since this is my entire trading system and I've been doing this as long as I have. I think that is a big contributing factor here for why my confidence is waning and at all-time lows for a big blow-off top moment. And that's simply because I understand where we are in the macro 4-year cycle. Okay, we are, like I said a couple of times now, just 2 weekly cycle lows away from the major 4-year cycle low. So if we're going to go, we really have to go pretty much immediately here and push to the upside. Otherwise, we're going to start to use up the next half of this weekly cycle low, okay? And then it's going to be time to decline. And by then, okay, it really is over. Okay, so just keep an eye on it, okay? Don't give up yet, but also understand where we are, and we really need this to happen pretty much immediately. I think one final point to make here before we move on is the whole idea, the whole thesis for this was to acquire a position at the 4-year cycle low and then look to stay on trend as long as physically possible until eventually we could offload it and then look to reallocate it again back at the next 4-year cycle low. When we look at it in this context, framed in this manner, it is pretty much mission accomplished. The only way we can really F this up from here is to give back the entirety of the move. Okay, so long as we can get out before giving back all of our profits, then I can still say pretty hand on heart that this is mission accomplished here and we did well to capture the bull run for Bitcoin. As I said right at the start, I am calling for a global bear market and recession imminently now. And here's the key part, that during this global bear market and recession, we will indeed have a short period of asset price deflation. This is very simply because anything you do to the M2 rate of change shows up in the CPI with a lag. And since we had this violent snapback in the M2 rate of change and slipped negative for a short period of time, I have been suggesting ever since we publicly called the top in inflation back here that we would indeed get a disinflationary trend that ultimately would slip into negative inflation, aka deflation. And we are expecting that to kind of manifest sometime in the middle of 2026. For an updated look at this chart, it looks like we're actually pretty much there, right? We have done all of this down and sideways part, and now all we're looking for is that final slip into deflation in the middle of next year. So we've got all of this, okay? All we need now is a quick plunge. And of course, nothing will catalyze this faster than a whopping great stock market correction as it comes tumbling down from its blow off top moment. Checking in on the Trueflation data, since we don't have any CPI data. I believe they're going to release it slightly later than normal, but it should be out at the end of this upcoming week. So by the next weekend's deep dive, we'll have a new set of CPI data to look at. But I'm still making the case that we can't even entertain this being invalidated as an idea until we get a new high set above this local high from back here. And of course, confirmation that this trend is still heavily disinflationary would be a breakdown below the lows. Everything in the middle is kind of no man's land. I often say this, but it's very true. Investors very quick to get caught up in looking at the short-term price action here and saying things like inflation is sticky, inflation is bottomed, resumption of inflation, the debasement trade. Choose your narrative. But the truth of the matter is everything in between this range is no man's land, okay? Start to break above, and then we can entertain the idea that this is no longer a disinflationary trend. Start to break to the downside like this, and then we can talk about continuation of disinflation before ultimately a short period of asset price deflation. Again, going back to this idea, if we are going to have a global bear market and recession, we would expect to see labor market deterioration. And that brings me on to my next component of this hypothesis, and that is that during this recession, we will indeed see labor market deterioration. We know that we've been having ADP missing data, okay, negative 33k versus 98k expected. This is going back a couple of prints ago, and the most recent print was another 32k jobs missed, okay? So again, I want to pause here to kind of point at some facts. Since we've been doing this, we've been suggesting we would slowly but surely see labour market deterioration, and the facts are that's exactly the trend we've been observing. Week in, week out, whilst nothing moves in straight lines, the overall trend has been a very clear one that the labour market is deteriorating. We've also been suggesting and speculating a little bit here that the data under the hood is actually a lot worse than they're letting on, because whilst they released this job data, which is already trending towards recession, they then have had a history of quietly going back and revising the jobs data to make it even worse than it already was. And then right as we're getting to the point where we should start to see actual recessionary prints, right as it should start to become obvious to the masses that this jobs data is actually recessionary, they just so happen to close the government down and freeze the release of jobs data, amongst other economic data. So all we had to go on, because there's no BLS data, is ADP. And this ADP, again, is not filling me with any confidence. This absolutely confirms the trend is still one of deterioration, and thus I still maintain that we are quite clearly heading into a recession. And again, every week we demonstrate that they continuously revise the jobs data down, they continuously slash jobs. In September, we got the news that they slashed them by almost 1 million jobs, and I'm making the case that we may well already be in recession. It's just that the NBER, the National Bureau of Economic Research, who are officially in charge of dating recessions, usually don't officially declare them until well after the fact. By the time they go back and paint them, most of the stock market decline is normally over, as is the recession in the economy. And there are plenty of other recessionary indicators, such as construction quits, which is of course a leading indicator, which is at levels not seen since the GFC. Henrik here showing the Piper-Sandler recession indicator, also looking extremely recessionary, and momentum in the RSI down the bottom confirming this move. We can also see this when we look in places like the unemployment rate, which is curling up at the edge. It looks a lot to me like a lead-in phase before acceleration to the upside, and of course those accelerations are synonymous with recessions, all at a time, I might add, where we keep hearing people parroting the idea that an unemployment rate of 4.1 is historically low. Meanwhile, 5 out of the 12 recessions on record started with the same unemployment rate, and one of them, the one from the 50s, started at just 2.6% unemployment rate, okay? And this trend continues everywhere you look. The unemployment rate for 16 to 24-year-olds, again, curling up, looking like it's getting ready for a big spike to the upside. Again, synonymous with recessionary periods. We can see the exact same trend in U6 right here, okay? Curling up, looks a lot like a lead-in phase before an accelerative sweep. And the SAM rule had a lead-in but has started to roll over, okay? So this is the only sign, and I do look everywhere I can, this is the only sign I can find to suggest that things are improving ever so slightly, but we need to see consistent and persistent back-to-back downside prints, not just in the SAM recession rule, but also in the likes of U6 and all these other metrics I've been pointing at, before we can actually say, okay, maybe we actually can entertain a soft landing. And remember, the Fed is really stuck between a rock and a hard place here, because it is putting huge amounts of weight on the labour market to make its decision for cutting interest rates, or indeed keeping them paused. And yet the jobs data lags so heavily that by the time they actually can see the damage in the labour market and then start to respond with rate cuts, it's far too late. This has historically always been the case, and I do not believe that this is incompetence. I believe that this is deliberate. I believe they engineer with precision these boom-bust cycles, and this time is not different. I still believe this is indeed a controlled demolition. And since we know with 100% probability at the moment we're going to be seeing a cut in October's meeting, Again, I am making the case the majority of market participants are going to get this wrong. The majority of market participants are going to be looking at the stock market blowing off. They're going to be looking at these rate cuts and increasing liquidity coming to the market as bullish. They're going to be looking at the GDP numbers as bullish, thinking the economy grew by 3% in Q2, nowhere near recessionary territory. Meanwhile, when we exclude net exports, GDP is at negative 2%. Couple this with the fact investors are going to continue to look at earnings beats in the stock market and cheer on the idea that we indeed have a soft landing, right? A return to baseline inflation whilst avoiding a recession. But I continue to make the case this is absolutely false and is going to wrong foot the majority of market participants on the basis that these are not cuts into normalization with inflation returning to normal and a soft landing. Instead, these are cuts into a slowdown, into a recession, which are historically bearish. In the short term, the market can usually withstand 1, 2, even 3 cuts for a few months. But by the time we get 3 months out of the first recessionary rate cut, we start to see bad things happen to the market walking forward. And so again, I am making the case that whilst investors are going to cheer on a soft landing and talk about how earnings are being beaten across the board and how rate cuts are bullish because liquidity is coming to the market, I continue to make the case that these are in fact cuts into a slowdown with labour market deterioration, a Fed that is extremely far behind the curve and has been overly restricted for far too long, and thus we're only a couple of cuts away here from seeing a slowdown and a rollover begin. Now, at the same time, this timing lines up with a top coming in before Christmas, of course. Since we had a rate cut in September, we're about to get one in October, and then we should probably see one in December. So all of this aligns with my idea that we're going to be topping before Christmas, and all of that, of course, aligns with the idea that we are now extremely late in terms of time for the 4-year cycle. Here's the stock market, okay? We are just a mere 12 months away from the expected 4-year cycle low window. And it's not just the S&P 500, it's also Bitcoin, of course, which is already on month 35, heading for that major 4-year cycle low window. Again, its 4-year cycle low is a mere 12 months away now. And at the same time, gold, which has an 8-year cycle, is soon to be heading for its half cycle low, aka its 4-year cycle low, right around the same time. So all of this to me is suggesting that based on the cycles, we are soon to be finding a top and start to have that declining portion of the major 4-year cycles. And this all seems to be backed up by the fact we are indeed heading into a recession. The majority of market participants are offside. And these rate cuts are indeed not going to be bullish. This is going to be one of those times where we are cutting into a slowdown, wrong foot in the majority of market participants. And thus, our days are numbered and we likely will be getting a top before Christmas. That's at least how I see it. Now, as I said right at the beginning, I've reserved the right to remain long and strong for a while longer if the market proves to me that I'm okay to do so. But as it stands right now, everything seems lined up for taking some serious profit and getting defensive into the end of the year. Something else we know about distinguishing between normalization cuts or recession cuts is when we're cutting into a slowdown, we normally see this happen on an inverted yield curve. And of course, this time around, we've had the exact same thing, right? The yield curve has been record inverted for a record amount of time. So it's difficult for me to say that these cuts are going to be cuts into normalization and a soft landing, because if that were true, like the prior times that happened, we wouldn't have had the yield curve invert. This time, of course, we have had that inverted yield curve, which again tells me these are indeed cuts into a slowdown. Pulling up the yield curve, this is the 10-year minus the 2-year yield curve, you can see that we are still not yet firing any accelerative sweeps to the upside, so therefore there is no alarm signal. Remember, investors always get this wrong. When the yield curve inverts, they scream recession and they're wrong. They do the same thing when it reverts back above zero, they scream recession and again they are wrong, because it's the acceleration to the upside on the weekly time frame that should be used as an alarm signal. It's this acceleration to the upside that shows us we have tops coming in for the stock market. And at the moment, we are still trading completely sideways, completely flat since the lows in April after the tariff tantrum, which again fits with the idea that we are not yet done with this final blow off top rally. Therefore, there is probably still a bit more upside into the end of the year. Again, fits with the theme of this hypothesis. But the moment we start to break down and experience true technical breakdowns and trend reversals here, once that is accompanied with an accelerative sweep to the upside in the yield spreads, it will certainly be time to take note, and thus this is why we use these things as alarm signals. We can sharpen this yield curve as we do every week, from 10-year 2-year to the 10-year 3-month yield spread, and this gives us even less time to react. Normally by the time this thing starts to sweep to the upside, the top is already in. At least that was the case with the dot-com bubble, the GFC, and the C19 plunge. This time around, still ranging, okay, but also compressing. This is a volatility compression here, okay, which is a pretty new development. So we're getting a squeeze here, likely before a big explosive pop to the upside. And keep in mind, usually the top is in for the stock market by the time this thing breaks out. So you have very little time to react here. Once the breakdown starts to occur, it's time to start to get defensive. And then when we cross-reference on this chart, we would expect this thing to start to pop, confirming that really is the top for this 4-year cycle, and we are going to enter a major global bear market. We use a similar concept on this channel for the high yield credit spreads. When these things break out and spike to the upside, it is synonymous with financially stressed conditions. Right now at the hard right edge, we are getting a little bit of a breakout. It looks like this thing's going to roll over. It's not too explosive to the upside yet, so I don't think we have to take too much notice of this, particularly if this turns out to just be a little bit of a fake out here and resumes back to the downside. Let me get my magnifying glass so you can see, right? We had the breakout. We're kind of undoing the move. That's fine. We're still kind of trading well below these prior lows from back here. So I don't think we've got any alarm signals just yet. But again, once the stock market breaks down and starts to really roll over and confirm a trend change, you would expect to see these start to spike to the upside. And again, we would use this as an alarm signal and a confirmation signal that those technical breakdowns in the stock market were for real and should be acted upon. So heading into the charts and the live positions, we continue to trade this thing in front of everyone. We've got our public stop loss level here at the right-hand side, level 3 members notified in real time. We're still riding this trade. We're looking for a daily and a weekly cycle low flush here. I think if we zoom in a little bit, it might be in already, but what I'm hoping for is one final undercut of these lows to give us that 2 drives pattern. And then I think we can draw a trend line across here and look to add on a breakout here with a stop below the low as always, as according to our cycle system. And then hopefully we can grab this trend line, re-encompass wherever the lowest low wicks are, and use this to continue to push the trades. So it looks to me like we're going to get a chance to add here, and of course we'll use the profit from the first trade to finance the risk on the second trade so that we can double our exposure without taking any additional risk. For gold, we are still riding this trade. I was posting a tweet this morning to say that I'm seeing a lot of people try to call the top here and short this thing, but we don't just short blindly, okay? Trying to pick the top and go short here is the inverse of trying to catch a falling knife to the downside, okay? We have to wait for, number one, a trend line breakdown, right? An actual breakdown to occur on the chart. And 2, we need to have that thing confirmed, okay? We need a confirmed breakdown to actually start shorting this thing. Otherwise, you're just trying to catch a knife to the top. And this late in the cycle, with the amount of FOMO and attention on this asset at the moment, I would not at all be surprised to see us start to really gap up here and put in a huge firework grand finale. So I would suggest nobody tries to jump in front of any trains here, okay? We'll soon get a trend line breakdown, and when we do, we'll soon be ready to flip short. But now is not the time, right? We've done really well at trading this thing since the lows, the 8-year cycle low back here. We've caught the move dozens of times over with higher beta assets like these mining stocks and whatever in the members section. So it's really just a case of staying on trend, okay? We're not trying to get cute. We're not trying to be the next Michael Burry and short the absolute top here. We're just trying to ride the trade until the thing breaks down. And once it breaks down, we can flip short, manage the risk as always. And then we know that we're going to be heading for that major cycle low late next year. Silver, I think, is, again, I'm seeing a lot of people get jittery here. A lot of people saying, oh, was that the top? Was it just a run of 50 and now we're going to roll over? But I mean, it's still above all these angles, isn't it? It's still got plenty of room to chop around and move to the upside here. And positions like SilJ are still running, right? We're still running. We've still got plenty of time left in this weekly cycle high window. So if the trades want to push, we're just going to let them, okay? That's just how we do it. Again, not trying to be cute, not trying to pretend like we know anything. We're just going to keep taking it one day at a time until the market changes direction. As for Bitcoin, we're still pushing this trade. I really have no idea whether or not this is going to continue to hold and end up being a profitable one, or whether we're going to get stopped out here at this current moment in time. But I have got the bullish case illustrated by this big squiggle here. And that would be that we're about to find a cycle low and then push higher, hopefully into a final blow off top moment sometime before Christmas. And then it's going to be time to head for the weekly cycle fail, left translate, weekly cycle, 4-year cycle. This is the current plan at the moment. Of course, we're going to have to be on guard for getting a weekly cycle here that rolls over to a lower high and then does this. If so, we're going to have to cut the trade in here somewhere and head for the hills, as the market will indeed be turning down towards its 4-year cycle low. But I'm going to remain cautiously optimistic here. There's no break of structure in place, so I can't really give up on the bullish idea just yet. although I am, as I said earlier, getting extremely concerned and starting to have my sentiment reset completely because I am just objectively aware of how much of this 4-year cycle we've used. But as per the live stream we did on Friday, I can't give up on this count just yet because, as always, I need to see a confirmed weekly cycle swing before I can actually make any decisions and set any invalidation levels. Whilst I'm here, I do want to show you a couple of things. First of all, the Camel cycle low indicator is expecting a cycle low to form sometime around the end of this month. Okay, so we're nearly there in terms of finding a bottom and a tradable low, and then it should be time to at least get some counter trend relief in the worst case scenario, and of course new highs in the best case scenario. And we've also got this, which is a 90-day gold offset. And if I clean this chart up, what I wanted to show you is this in yellow here is the gold chart, offset 90 days. Gold tends to bottom and move up 90 days ahead of Bitcoin. And you'll notice that for the most part, the highs match, the lows match. There was a period of divergence in the middle here where Bitcoin was running to the upside whilst gold continued to trade down for a little while. But by the time we got this low in place here, they started to move up together again. And then you'll also notice they bottom at the same time, gold moves up, so does Bitcoin. They top right here at the same time, okay? They bottom at the same time, roughly speaking. Gold leads the way, Bitcoin soon follows. And now we've had this whole consolidation and gold has indeed ripped to the upside. And now Bitcoin seems to be like it just needs to chop around a little while longer, find that cycle low and go. And hopefully that final grand finale move is ready for Bitcoin. Something else that gives me a little piece of quiet confidence here that we are not yet seeing the top in Bitcoin is just like in this consolidation for gold here, a lot of people were getting bearish. And I was saying, I don't think it's right to be bearish. I think there's another leg to the upside for gold because during this consolidation, the miners were just ripping and ripping and ripping and ripping. And I actually think that's what we've got here at the moment for Bitcoin. We've got this consolidation, we've got the market in aggregate getting very bearish here. And at the same time, when we look to these other crypto stocks and miners, they're all mooning to the upside. And I'm even seeing this weird phenomena at the moment where a lot of people are trying to explain away this upside price action in the crypto stocks as some kind of pivot to an AI narrative, which I just think is ludicrous. I think like cycles are in control and what a weird narrative that people have married, but to each their own, right? All I know is we use the Bitcoin cycles and the cycles for these assets to say that that should be a 4-year cycle low, and at this part of the cycle they should be mooning, and now they're mooning. So you can blame this price action on the AI pivot narrative or whatever all you want, but I'm not buying it. I don't believe that's the case, and instead what I think we've got is cycles doing cycle things. We're going to continue to trade these in the level 3 members section, of course, and we'll just take it from there, right? We'll see what happens one day at a time as always, but so far they're all doing pretty well, and I expect that these are going to continue to move higher. And of course, here's the key part. I believe they are leading Bitcoin higher, just like we saw the miners in the metal markets leading gold and silver higher. Eventually they broke out and did very strong, powerful moves. So I think this is coming to Bitcoin. I'm not ready to give up on the bull case just yet. I think all we need to do is get this weekly cycle tucked behind us, and then it should be time to party. We've also got that 106-day cycle due to bottom here as well. So daily, weekly, and 106-day cycle all getting ready for that grand finale move. I think a lot of people are going to quit right before this is revealed, but it's up to them, right? To each their own. I'm going to keep doing me. And again, I'm still going to be open to some downside here. So keeping everything on the table, reserving the right to change my mind as I need to if the market dictates. Other than that, I'm your boy Camel. If you're a level 3 member, look out for the members only video I'm going to post for you guys. For everyone else, consider subscribing, especially if you made it this far and want to continue to follow this hypothesis through to completion. Other than that, have a fantastic weekend. I'm your boy Camel. All the best from me. Cheers. Bye.
Camel Finance, he's the man to see. Rocking the markets with his contrarian spree. Trades like a pro, no fear, no shame. Sticking to his guns in his money game. He's a badass, oh yes indeed. Camel